So yeah, last time we went over kind of the returns and just kind of setting up kind of the analysis. Yeah, hope to show today is just kind of the outputs that's given us to to see what the different results are over time. But as we have gone over in prior videos, that debt recycling in and of itself, obviously it saves tax if you go down that road, but at the end of the day, it's an investing decision, and with any kind of investing comes risk. So we just want to kind of say, well, what did that risk look like over time? What I've done here is this is kind of a scenario with a couple both on 160 odd thousand dollars investing in a portfolio of international shares at 60% and 40% into Australian shares, and just seeing what that looks like after tax over time. So if we look at here on my screen, so we can see that you might remember from the prior video, and I might leave a link to those returns in the comments, that we can might remember that obviously in 1990 interest rates were quite high, the highest that they were, and in that year as well, investment returns were poor. So we can see obviously in that year when interest rates are high, after a year, after multiple years, you would have been better off actually paying down your mortgage as opposed to paying that down and redrawing that and investing obviously into bad investment returns. So what we can see here is obviously there's a lot of numbers here, so we can kind of concentrate just on this 1990 example. And obviously that goes back the furthest, so we've got the most number of years under that example. So what we can see here is in that first year, if let's wind back the clock to 1990, after 1 year, you would have been 23% worse off debt recycling as opposed to just paying down your mortgage or putting it into the offset account and saving the interest. And then after the second year, you recapped some of those losses. So investment returns were better in that second year. And then you can see you've gone backwards again in year three, so that you can make the assumption that in 1992, investment returns were poorer. In year four, you've gone into the black. So you've then it's kind of broken even effectively at 2%. Go back, and so you can kind of see along the journey at the different time intervals that it's not always kind of smooth sailing. Like there's no kind of investment journey that's smooth sailing. So we can see here that it kind of keeps its broken even and it gets quite profitable in 1990 after say 7 years, and it holds on to those returns, and it holds on to them for a while. It gives some of those back, and there were poor returns in 2002. So you can see at year 13, after year 13, that you're pretty much broken even again. And then when the GFC hits, you go backwards, so that after pretty much in the middle of the GFC, after being up, after being down, after being up and down, you would have been 27% better off actually just paying down your mortgage as opposed to debt recycling. And then from year 24, that's actually the kind of the longest period from a debt recycling point of view, where it actually you've broken even from that, and then it holds. So you can kind of think of from 1990 all the way until 2023, and that's 34 years worth of data. You're 46% better off investing in this portfolio as opposed to just paying down the mortgage and saving the interest. So that's obviously the longest, and you can kind of look at that over any point in time. Just but before I continue on any longer, did you have any thoughts or questions on that?
Two observations. Number one, I think I said in the pre-recording, but I've had that situation in the past where if you look at for year 10, you'd be looking good. You'd be sitting there going,
Yep.
hey, I'm pretty smart. But then you go to year 22 and you sit there and you're starting to potentially regret the decisions you made. So I look at it and I say, well, I guess the important thing is figuring out the strategy and sticking to the strategy, because it doesn't help you if you get to year 22 and then you decide you want to change your strategy. It's actually going to make it worse. But it's actually really interesting to see that obviously that's the worst case scenario, but it's taken really, you could say, where it's starting to get a clear benefit is really 30 odd years, but even at 30 years, it's still the same level as the 10-year mark. So yeah, I guess you've really got to pick your strategy and stick with it.
Yeah, because I think going along that, like any kind of investment journey, like should be a long-term endeavor. So you can kind of see, like, and it's so important that you maintain that strategy, because if, for instance, you went with a strategy to debt recycle and invest, and you obviously would have been down over those first couple of years, so that it's not uncommon that naturally in that kind of situation we get fearful and might want to sell down and say, well, I'm just going to put it into the mortgage and sleep better at night. If you then go down that avenue, you then don't have the opportunity to get those inevitably higher returns at one point. We never know where they are. Those higher returns to then recoup those poorer returns that if you're unlucky enough to start investing in 1990, if you change strategy, you've then locked in, and then you're going to obviously get the return of the interest rate, whatever you're saving. And that's kind of crystallized that loss in that situation. So you're never actually going to, I guess, recover from that. So that's probably the most crucial kind of, and it's not exclusive to debt recycling, but any kind of investing journey. You need to be a long-term investor. when running this analysis, I was quite surprised. And obviously, 1990, that's probably it's the longest data point that we have, but that kind of included a few different crises over that situation. So that's I would say one of the worst situations in terms of that break-even point where it stays into the black thereafter. But I was quite surprised how long that is. Like usually, like when you think about investing, like most investment portfolios or products, I'll give a minimum investment time frame of 7 years, and that's pretty much like around the mark of worst case scenarios to, I guess, regain your capital. So if you invested $100,000 like just before the GFC, you obviously would have been down, but then after 6 or 7 years, including dividends, that $100,000 was $100,000 again. The difference with mortgage investing, because those returns are effectively baked into this analysis, but the difference with paying down your mortgage is, and I touched on this in the prior video, is you're always chasing a positive return. So in that prior example with 7 years, that $100,000 that was $100,000 that you were chasing, so it wasn't moving. Whereas in this analysis, why it goes out to be 23 years as opposed to 7 or a normal market kind of break-even point is that $100,000 goes to 114,000 and 120,000. So with this analysis, where we're effectively chasing the goalpost of paying down the mortgage, even when
Yeah.
you have got a good return, that in that situation you've got a good return as well by paying down the mortgage, whatever the interest rates were over that period of time. So that's
Mm.
why I think my analysis or kind of takeaways from this analysis is that I think it's a combination of both. That here we can see that over these worst periods, that I think 23 years, that's probably even the most patient people wouldn't want to wait that long. But there are plenty of periods as well where it's a lot less than that. And over here, for instance, that you can see over the longest period, the advantage, you're 46% better off. So effectively, let's say you put in $100,000, that your portfolio at the end of it was 46% better than if you'd just paid down the mortgage. That's still not a bad outcome, but it's over 34 years. It's not crazy. Just if you are lucky enough to avoid that 1990 situation and invest in 1991, it's 82%. So that's kind of the worst scenario in terms of you're just unlucky.
This is really interesting because I think some people would just pick a strategy and think, okay, this one will work. One straight, like for example, if you waited for the GFC crash and you got in 2012, you'd be sitting pretty good. But if it was 1990 or the year 2000 or something like that, it actually takes a long period of time for things to work out.
Lots of red there.
And I think just because something happens, like the thing that I'm taking out of it is like you got to stick to that strategy because you might cop some losses up early, but you got to have confidence in your strategy because if you don't, you'll sell out too early. But I also get what you're saying is if you're in 1990 and you're waiting 20 odd years to basically start to get to clear water, 25 years, that's probably too long for most people as well.
Yeah, and it wasn't read all the way through. So that's kind of the other point as well. So like some people might have had the temptation after 10 years, maybe realize some of the portfolio and pay down more of their non-deductible debt or mortgage. Like they would have been fortunate in that situation because they've kind of timed it and sold down it before these kind of bad years. So like it's
Right.
rare like anything. And this is why I think this exercise, why I thought was important, that no returns are linear. So like it's not a case of always going one way. So there's ups and downs with the strategy. So sometimes you're even in 1990, for instance, that you're down, then you're up, and then you're down again, then you're up again. So it's a bumpy ride and obviously a long time in that situation. Another point that I would add is here we've got, this is obviously just the debt recycling scenario, but if we compare that to, I ran the analysis, obviously, if you don't debt recycling, if you just kind of took those funds out and just invested, you can actually see over here in that situation, there's just a lot more red with that. So these are the exact same investment returns, exact same incomes, etc.
Just kind of repeat that again. So this scenario is if you just had 100 grand cash,
And just
right?
invested that. So you didn't go through the process of paying down your non-deductible debt and redrawing it for the tax advantages. So you're still investing the same amount. You still got the same market risk. You just haven't structured in the correct way. And this is probably why I'm passionate about debt recycling, is because it's one of the only kind of free lunches, if you like, in investing, in terms of if you've made the decision to actually invest, that you've got this market risk in any case. So if you debt recycle, at least get those tax deductions. So you can see here that so after year one, you would have been negative 28%. as opposed to negative 23%. So there's let's call it a 5% difference. So that you can kind of think, I think it was 14.52% was the interest rate in 1990. That difference at 5%, that's roughly like kind of the tax benefit of a 14.52% tax deduction in that year. And that tax deduction obviously gets lower when interest rates are lower in the years thereafter. But each year you're kind of just pocketing those tax deductions. And obviously the tax savings on those tax deductions. So that's what kind of makes it a little bit more, that's what adds to the return. So that then when you
Right.
actually kind of extrapolate that, if we look at 1990, so that 34 year, obviously in the debt recycling scenario, remembering back, you're 46% better off. Whereas if you didn't debt recycle, you're literally 1% better off. So this is where
Wow.
I wouldn't give it a rule, but I would almost make for somebody who's a little bit kind of risk averse, like if you're not debt recycling, you probably should just pay down the mortgage because obviously on that, the funds that you're investing, you're going to get taxed on that, get any tax deductions on the debt because you haven't structured it correctly. So there are situations still where investing as opposed to just paying down the mortgage still makes sense. But it's always worse off as opposed to debt recycling because those tax deductions are on the table no matter what with that. So we can see obviously in 1990, for instance, you're 46 first one, so there's a 45% better off. If we go to say 2009, just picking a random year, it was 67 over here. If we go to 2009 here, it was 96% better off. So over time, you can just see that that's where the benefit each year of those kind of tax savings, which are variable based on the interest rate in that any given year, that's kind of, you're just pocketing that and accruing that each year. And then so what I'll do is I've kind of got another kind of way to look at that over here. So here what I've done is just kind of summarized each of those periods. So here is up the top is just debt recycling. Down the bottom is not debt recycling, and here's kind of the difference between that. Here we go to the 34, like a time frame, investment time frame of 34 years. We only have one of them, obviously, because that's the longest. So next year, when we bring in 2024 data, we'll have 2 years of that, and we'll have a 35-year period. But at the moment, we just have the one. So that one example, when you debt recycled, you're 46% better off, where you're 1% better off, effectively broken even if you didn't debt recycle. So down here, I've just kind of put the difference between each of those. So that then what we can see from 24 years where you debt recycled, from thereafter, there were no negative kind of years where you were actually worse off. Whereas where you didn't debt recycle, 36% of the time you're worse off, 30%, 11%, 13%, 17%. So after 30 years, you always remain better off, but just better off because obviously from 1990 you were only 1% better off, so it wouldn't have taken much for that to have been a negative year. So that here you can kind of see the difference that you're always better off, obviously debt recycling, but I think this would kind of just looking at this percentage, because now that we've made the decision to say that, well, it always makes sense debt recycling, you can probably just ignore these numbers here and just concentrate on this table here just to make it a little bit more somewhat easier
Well,
to digest into the numbers.
I think the summary I took away from that is if you want to do that investment, so put money into shares, for example, and you've got a home loan, structuring is important because if you structure your debt in the right way so that you're maximizing your tax effectiveness, that's going to be better 100% of the time.
Yeah, because those tax deductions are on the table no matter what in that situation. So I would add, probably going a little bit above the scope of this call, I would add the only caveat where you shouldn't debt recycle if you want to invest is if you currently have a home that's going to be turned into an investment property. If that's the situation, you just want to kind of pause and maybe just do a few more numbers or send me an email or something like that, because that's probably the one situation. If somebody has a home, it's not uncommon for an Australian to have a home that might be their first home, and then at one point they might have a family and upgrade, and then if they have the capacity and inclination, they might keep that former home as an investment property. If that's the situation and that's going to happen imminently, and then you're going to hold it for a long time, in that situation, you probably shouldn't debt cycle because you're going to lose tax deductions in terms of the structure. So won't go down that avenue too much, but just one caveat, because don't want to people to open the floodgates and go down that avenue, because there's that one caveat.
Okay, yeah, but even then, you could effectively structure. So long as you've got your strategy clear, you can effectively structure for that scenario as well. Yeah.
It's actually quite hard to I guess structure that scenario, because with debt recycling, like as part of the process is you pay down non-deductible debt and then you redraw that, and then for the investment purpose. So if you currently have
Right.
a home that's going to be turned into an investment property, you actually want to maximize the debt on that when it becomes an investment
Mm.
property. And by
But
debt recycling, you've kind of killed some of the debt that otherwise could
yeah,
have
yeah,
been
yeah. I get, I
tax
get,
deductible.
I get what you're saying. Oh, like in terms of maybe take the term debt recycling out of it. You could effectively do it by putting those returns into your offset account because you're not reducing the loan limit on that owner occupied loan, but you're still getting the benefits of the reduced interest on it. Would
Yeah,
that be
yeah,
right?
it's always a tricky situation, and
I guess
like
you're
when
still
that's
paying it down quicker.
yeah, I think in that situation, if someone's imminently going to turn something into an investment property, probably normally I'd just say just keep it in the offset account. And then once you're in that forever home, when it's turned into an investment property, then debt recycle. There can be
Mm.
some instances where they could just actually invest that cash. As I said before, that and what I say, like invest that cash and then maybe at one point in time restructure the portfolio and debt recycle it at that point in time. As I said before, that over a short period of time, that's not a guaranteed strategy with that. So yeah, probably wouldn't want to go down into the weeds too much on that. Rather just yeah,
Mm.
just add the caveat that there's one kind of situation where you don't want to debt recycling. You just want to be a bit more careful of paying down that non-deductible debt if it's going to be turned into deductible debt in the future with that. So just jumping back onto this, that here we can see when we're debt recycling that all the different timeframes. So obviously looking over a 1 year time frame, we have 34 of those. And then 35% of the time, you actually would have been worse off debt recycling, just looking at a 1 year period. And then 30% over 2 years. And then so we look at, I guess, more reasonable timeframes or like what people kind of think of as an investment journey. So over a 10-year period, the worst you would have been off would have been negative 38% compared to just paying down the mortgage. So that probably would have been like a 1990 scenario or something like that. The best you would have been off over 10 years would have been 156%. So that's how big the range can potentially be. And that's why you can have so much luck that over a 10-year period, you could have had half you could have been 56% worse off or 156% better off over that period of time over 10 years. And this is where like generally the market trends up, and like when we looked at the averages last time, the returns were on average greater than obviously the interest rate over that period. So on average, you're better off debt recycling. So 32% over 10 years, your kind of portfolio is going to be 32% better off. And the median, so just the middle number there, you're 28% better off by debt recycling over a 10-year period. And then so there's 25 of those 10-year periods, and 5 of them were actually negative. So there was a negative 38%, we know that, and there would have been a few different kind of numbers down to zero for that. So you can make the summary to say there's 20% of the time over a 10-year period, you would have been worse off by debt recycling. I guess a few takeaways from this is number one, debt recycling makes sense if you've made the decision to invest. Number two, that, well, you need to be a long-term investor. It can be quite long to actually make that a profit strategy as opposed to just paying down the mortgage or offsetting the mortgage. And probably the third one is that it doesn't have to be all or nothing, as mentioned in prior videos. It can be a case of saying that, well, if I have $100,000, maybe I'll go $50,000 debt recycle, leave $50,000 in the offset account or pay down the mortgage, or any number in between. Could probably add to that as well and say that, well, you don't have to do it all in this year. So if we jump back to the table over here, if we look at 1990, for instance, that if you had $100,000 in 1990, you didn't have to put all of that into the market at that point in time or debt recycled it all at that point in time. You could have said that, well, I want to have $100,000 of investment exposure, but maybe I'll do 50% this year and 50% next year, or 25% this right now, 25% in 6 months' time, 25% in 12 months' time, and so forth with that. So I
Right.
think with this, there is the sequencing risk. So I find a lot online on online forums that dollar cost averaging or drip feeding into the market, which is when you kind of say that, well, I've got this amount of money, I'm not going to invest it all today, I'm going to invest it over a period of time. I think
Mm.
that probably gets a negative rap because there's studies out there, which I don't contest the studies, that naturally the market trends up. So studies say that, well, 70% or I think it's 60 to 70% of the time, you're better off just investing that into the market as opposed to dollar cost averaging over 6 or 12 months. So that I think people read that and say that, well, it's rational just to invest it, you know, the risk of investing, and that's the best decision. I think there's number one, there's the emotional benefit of dollar cost averaging or drip feeding into the market because you need to kind of ensure that you're a long-term investor. So if you put it all into the market and then 6 months later there were horrible returns and then you might not have been experienced at investing and obviously there can be the feelings to have regret and unwind that decision. Like that's almost the worst case scenario. So dollar cost averaging is almost kind of accepting, I guess, not get the worst return, I'm not going to get the best return, I'm going to get like somewhere in the middle. I'm going to narrow the range of potential outcomes. So that's one benefit of dollar cost averaging. Another one is I think it can help with decisions because naturally, if you know how important the decision is, if you see these numbers and how important like what year when you actually invest is, that can actually lead to probably like analysis paralysis and people thinking, well, I've got $100,000, I've got it, it's all structured, it's all ready to go. Do I invest it now? Or it's been bad returns lately, it's been good returns, whatever people's different theories are. And then they might not actually ever do that because they're scared because it is so critical. Like it just has a bigger rate. Like it just goes on the numbers more if you don't dollar cost average either way. Whereas if you dollar cost average,
Yeah.
it's almost a case of just accepting, well, the market is what the market is, and let's just kind of average in. And sure, if you invested and then the market goes crazy, you would have preferred that you had 100% exposure to that. But just on the other hand, if the market crashed, you would be happy that, well, I only put in 25% of my portfolio. Now I've got 75% left and I'm actually buying in at lower returns. And then
Right.
hopefully the higher returns come thereafter. So I think that's a case to say that, well, you don't have to invest at all. You can kind of straddle 1990 and 1991 just to average the return so that you're not getting the absolute worst outcome. And similarly, that's obviously the positive side of it. If you did that, you're not going to get the 121% in this situation because you would have been straddling these years in that example down there.
Right.
So you got to take the good with the bad and vice versa. But that's another kind of takeaway that you don't necessarily have to be exposed to any given year. You can kind of, number one, take a balanced approach and then average into that.
Yeah, really interesting stuff. I find through just the videos I do online, people are always on one side of the boat. You know, they might be a gold bug, Bitcoin, crypto. They might be into shares or super or property. The thing I've learned over all the years, kind of watching on the sidelines as a mortgage broker, is it's rarely as easy as what people think.
Yep.
And we do have a recency bias here. And that's my greatest fear, like with my clients, is that people think it's easy. And I know
Yep.
you've got to own your mistakes. But when it's someone's lifestyle or their family's kind of finances on the line, personally, it does worry me a little bit. I like this sort of information because it just shows that things aren't as easy, and therefore you have to adjust what risk you're taking with your financial decisions.
Yeah, and hopefully, obviously, there's a lot of numbers here, and people could see the red and think that, well, I thought it was all rosy, and investment returns are positive after 7 years, and things like that. So hopefully, it is, I guess, data is empowering and helps people make decisions either way with that, as opposed to thinking, oh, it's all too complicated or something like that. Because yeah, obviously, lots of people debt recycle every day. Probably few people have like know the numbers or have done like the analysis, and people have done very well. Like obviously, people that have debt recycled since 2012, which is probably, to be honest, since it's become popular, like people probably weren't talking about debt recycling in 1996 and things like that, is that a lot of people probably have done well from debt recycling with that. So I think it's more just a case of saying that, well, there can still be situations, there is investment return risk, and it's not a bad strategy to actually pay down the mortgage. But at the same time, that statistically, on average, that since 1990, you have been rewarded for taking on that risk and debt recycling to optimize it, so that it probably comes into the equation if you are willing to take on a little bit more risk to get ahead.
Excellent, mate. Any other observations or anything you think the audience needs to know that we haven't gone over, either in this video or maybe something you want to reinforce from one of the other videos we've done?
I'll leave the link to this in the comments so people can have a look at it for themselves. This is based on $160,000 of joint income, or $160,000 each. So in terms of what happens if, for instance, your tax bracket's higher than that, it's tilts it a little bit more into paying down the mortgage, not drastically. And on the other side of that, if your income's lower and your tax lower on investment earnings, it's slightly better to actually invest because you're not getting taxed as heavily. Vice versa to that, when you compare debt recycling to not debt recycling, to that previous analysis, the higher your income, the bigger the difference between that, because obviously the tax benefit is higher as your tax rate is higher on those deductions. So that's a couple of themes, but it doesn't actually change the numbers too much based on your actual tax rate. So this is based on a 39% marginal tax rate, but if it's 32% or higher or lower, it doesn't change the red to blue, for instance.
Excellent. Yeah, I reckon we give that a wrap. If you want to, there's a fair bit of data here. So if you want to ask questions, just chuck them in the comments and Kyle will get onto them. And we'll leave Kyle's links in the description as well if you want to
Yep.
chat to him. Showing yourself in the comments if you want to have an individual one-on-one chat, you'll be able to find his details in the comments.
And just one extra thing, I have put together a white paper, so just documenting all of this, so in a little bit more of a digestible format, or you can take a little bit slower if you'd like to do that. So I'll leave the link to that in the comments as well.
Beautiful. Thank you.
Awesome. Thanks so much, Will.